let's go back to the adjusting process, and I'm going to say this is going to be for 228. So we have an ADJ, unearned revenue. So now what I'm going to do then at the end of the year, particularly if I know that I'm in an industry, if I know this guitar shop has this situation where people order guitars and they put down a deposit before to hold on to the guitar, and I know that the guitar shop puts that in place as a negative receivable, which is often the case if there's deposits. So any type of industry that has deposits, that's what you want to be asking. If they were a rental company and they have the last month's rent, or if they are a newspaper or subscription company, how are they recording their revenue that they're getting in advance? Now, again, oftentimes they're going to have a system where they enter, say, a payment form into QuickBooks, which is usually the form that you enter after the invoice, but they might be entering that before the invoice and then matching the payment form to the invoice, right? And they enter the invoice afterwards once the revenue is earned. So if that were the case, and we say, okay, maybe that's the case, how would I know that? I'm going to go into month 2 because this is where the subledger has more detail. And I'd have to go into their subledger and see, this is the accounts receivable subledger. It's over on cell AX over here. And if I scroll down, I can see that some of the receivables have a negative balance. This one in particular for customer Eric Music, I think it is. Is that the one? Yeah, has a negative amount in it. Notice that the accounts receivable total is not negative. This accounts receivable total should match what is on the accounts receivable general ledger, and it's positive. But I have to look through the subledger looking at the accounts receivable per customer and see if there's a negative balance, which I can see here. Now, in some cases, it might be possible that the customer actually has a positive balance, meaning that they still owe us money, but that there's a deposit in it that hasn't been applied out. So in this case, we have, for example, this one up here, this 250 for Smith guitars is a result of they owed us money for one sale, but then they had another amount here that they deposited that wasn't applied to the invoice, but rather was a deposit for another guitar that they're going to be purchasing in the future. So we would have to look to be detailed. We'd have to look through the accounts receivable and look for payments per customer which haven't been applied to an invoice, which should be fairly easy to do and would normally result in customers having negative balances in their accounts receivable accounts. And then we could just say, okay, I'm going to adjust the accounts receivable for those negative balances because they shouldn't really be negative balances, because a negative balance in accounts receivable basically means that we owe them, which we do. We don't owe them money. We owe them hopefully the guitar that in this case that we promised them. So I'm just going to increase the accounts receivable by the amount of these amounts and post the other side to the unearned revenue, properly reporting it as a liability instead of an asset. So that's going to be the adjusting entry. Again, it's a little bit different than a book problem. So the two amounts are the 450 that it adds up to. So that's going to be our idea. Now notice that if you're doing these adjusting entries only for tax purposes and they're a small business like a sole proprietor, you might not need to do this at all because the Schedule C doesn't have the balance sheet on it. So the income statement is properly reported the way we are doing this right here. And so it shouldn't be a problem for the income statement. It's only if you have to adjust the balance sheet, which you would need to do if they're a larger business, which would have to report a balance sheet for taxes or possibly for external reporting if they needed to make financial statements for, say, the bank or for their own internal needs or for investors, for the bank if they needed a loan or for investors, right? All right, so then we're going to say, all right, so what's this going to do? The accounts receivable needs to go up by the 450 for those negative balances for the customers. And the other side is going to go to unearned revenue. It's going to go up. Unearned revenue is going to go up Boom, boom. I'll put zeros across the board. And then now when I'm doing this in my Excel worksheet, it's nice and easy to do. I could just do a journal entry like this. But if I was to enter this into the QuickBooks system to make their financial statements correct as of the end of the period, I'm going to run into a problem for most software like a QuickBooks or a Xero, which will not allow me, once again, to post to the accounts receivable unless I do something to the subledger, because it will throw off the subledger to the general ledger. My subledger will no longer match the general ledger if they let me do that. Now, in this case, I wish they would let me do that anyways, because what I want to do is not touch the subledger, because that's going to mess up the bookkeeper, but rather enter the adjusting entry here and then do a reversing entry as of the first day of the next month, so that it never messes up the subledger, which will confuse communication with the actual customers. So, but I can't do that. So I have some options if I'm going to enter this into like a QuickBooks system. What am I going to do? Well, I could make another account called accounts receivable, but not make it a accounts receivable type of account. And therefore the software will not give it the same kind of subledger and force us to add a customer for it. Although that's kind of ugly in the reports, because now you're going to have accounts receivable grouped under accounts receivable and then another one that's a other current asset, which is kind of ugly. Or we could say, we could actually post to the client's account here. So the two that we have, I think it was Smith Guitars and I forgot which two, the one, whatever customer it was, I can enter it into their subledger. But that's going to be kind of ugly, because then when you communicate with Smith Guitars, it's going to show this journal entry. And journal entries aren't normally what you see in there. It's usually going to be invoices and payments. So that's going to mess up the bookkeeper a little bit as well. Although hopefully we could just match out the adjusting entry to the reversing entry so we can see that it would match out and it wouldn't mess them up too much. But another option is maybe we just make up another customer for the adjusting entries just so that we can record it. And I'm going to call that customer ZZZ adjusting client, so that it hopefully shows at the bottom of the customer list and is only there for our adjusting entry, so it's kind of out of the way. So this is kind of the middle ground of creating another account that's going to be in the other current assets, or putting it in the detail and messing up the detail. So I just make this other customer. So that's what I'm going to do. I'm going to say this is going to be equal to the 450, increase in the 450, matching what we did to the receivables. I will copy down the balance. So let's copy down the balance. That brings the accounts receivable subledger balance up to 23,151. Does that tie out to what we're going to have in the general ledger? Let's check it out. Accounts receivable is going to be the prior balance plus the current activity is going to be the 23,151. Is that what I said it was? Yes, that's correct. All right, let's let's copy this down. We'll copy down the formula. So notice this is why this is not a classic adjusting entry the way we did it here. Why? Because it doesn't have an income, there's no timing component to it. If it was a book problem, there would be a timing component, because the idea would be that we're just going to keep on recording the liabilities upwards and then figure out how much has been earned, reducing the liability, recording the revenue side. So that would be a classic adjusting entry. The way we're doing it, and with software, this is often the way even a subscription model might be set up, right? Because if you have the subscription model, you might be able to set everything up from the start to kind of automate the process, and therefore you don't have to manually count how much has been earned, right? Because you could say, if you got a yearly subscription, I'm going to record the payment for the yearly subscription, which will be a negative receivable, and then I'm going to record a series of invoices possibly that will be timing invoices, which will then automatically post monthly, right? So I can actually do a reminder invoice so that on a monthly basis, I can automate the process of it recording an invoice, which will match out to the prepayment. So that's why we don't normally have that book problem scenario where we're manually going in there and trying to figure out how much has been earned. Although in some cases you might still see that, but you might more commonly see something like this situation where you have to see how are they recording the liability. Did they record it as a negative asset or a liability? How does the software account for this payment that was received before we did the work? All right, so I'm going to put an underline under this one. Let's put an underline under here. And underline, boom. And then we'll copy down the balance. Copy that. Let's drag this one down. We'll drag it down. Put an underline under these. Underline. And then we'll say this equals the SUM of prior balance, current activity. Copy that. Roger. Holding down shift, right arrow, all the way to the right. Boom, boom, boom. And then right click and paste it, just the formulas. Okay, and then we'll copy down this and copy down these for formatting's sake. Bam. And so there we have it. So now the accounts receivable is at the 23,151 and the unearned revenue is at the 450. And so that is correctly breaking out the liability for reporting's sake. Now notice that if I didn't reverse that, it would look kind of ugly if I enter this into the QuickBooks system, because because on the QuickBooks side, they don't use the unearned revenue. So this is going to look ugly. So what we'll typically do is just reverse it, do a reversing entry as of the first day of the next period to get the financial statements tied out correctly, but then just reverse it on the next day so we go back to the normal formatting that works well internally for the bookkeeping's perspective. This being something that, again, a lot of people in public accounting don't understand, especially if they're in larger financial accounting departments. Work like if you worked at like an auditing department and for public accounting and whatnot for reporting purposes, and then they work for smaller businesses, sometimes aren't able to communicate between the accounting department in terms of what their needs are for internal reporting, because all of their focus is, of course, on this really complex process of getting the financial statements recorded in accordance to very strict accounting rules of generally accepted accounting principles. And they're not really thinking about, okay, once I do that, how can I make sure I don't mess up the accounting department when I enter these adjusting entries? But if you're in small to mid-sized businesses and doing taxes in particular, that becomes something that's going to be, of course, very important, because you want to find that balance between making sure that the financial statements are reported correctly, at least for taxes, but not messing up the accounting department when you enter it into the system. How are you going to enter that back into the bookkeeping system without messing them up? Reversing entries are something that we can keep in mind to help us with that process, which we'll possibly do in future presentations.